today was the big NFP day. We got actually we got a lot of economic data this week. You know, for a holiday shortened week, we sure got a ton of data. And it kicked off, I'm just pulling it up on my screen, it kicked off with the non-farm payroll jobs numbers, which were, I'm trying to think of a kind way to put it, but they were a effing disaster. Just remember the last read was supposed to be 200,000 jobs and it was 160,000 jobs, which is a pretty bad number. That was revised down. For some reason, I'm not seeing what the revisions, oh, they were revised to 123,000. So it was even worse than expected. It was supposed to be 200K and now it turned out to really be 123. And then today, the consensus was 158,000 and we only had 38,000. So the rate of change as far as the jobs it's going down, right? I'm starting to think we might start having zero or even some negative numbers coming up soon with the jobs numbers. This should be no surprise to those of you that have followed me for a while. I've been, I think, at the vanguard of talking about the havoc that AI and automation is going to wreak on the jobs markets, really from now till forever. It's never coming back to the way that we knew it. It's not your father's Oldsmobile, so to speak. The problem is that a lot of the jobs that human beings have typically done are now being ceded to automation and AI. It is fantastic for supply chain management. Usually when we have a big economic downturn like the one we had in 1929, for example, it usually starts off as an inventory recession. That is still possible. I mean, we could still have some oversupply in inventories, but it can't be to the magnitude that it's been in the past because of supply chain management by robots. You can't kind of blow the business cycle as badly as you might have been able to do in the past. Anyhow, that was the story with NFP. Someone just typed something rather long in there. I wasn't able to really catch it. If you want to circle back to me later on, I can't really read long comments in the video. You can always post a comment or tweet me, and I'll try to get back to it after the broadcast. We had some other readings today. We had a PMI readings, both manufacturing and non-manufacturing. I'm sorry, I think we had PMI and ISM. So the prior period in the PMI was 52.8. Today was 51.3, so that's slipping. ISM non-manufacturing was supposed to be 55.5. It wound up being 52.9, so that's slowing. And then factory orders were a slight miss. No biggie there, but that should be no surprise. And I think the trade imbalance wound up being a little bit better probably because of the weak dollar. So where are we here? Let's go back to the beginning for a moment. I have invented a hashtag that has gotten been bandied about quite a bit on television, and it has never been properly credited. It is called lower for longer, and this means that interest rates, as we know them for treasuries, will stay lower for a longer period of time than people realize. It's been adjusted, and I've heard it bastardized and used for other tickers or what have you, but the real origin was right here, and it was for interest rates. Now let's discuss the problems we face briefly. The Fed, in all of their infinite wisdom, these are very highly intelligent people, so to speak, have been quite awful at forecasting growth and inflation. And their curve that they have been expecting on when they've been raising interest rate, their interest rate hikes has been wrong. I mean, they haven't been. They're for some reason they're shocked at these numbers. And I think the scariest part about today's numbers is that leading into them, the Fed heads, the Fed presidents, other than Yellen, I want to asterisk that because she is very important here, and we're going to get to her in a second. They were all talking about things getting better, and they see rate hikes coming, and if the data warrants it, then it sounds like we're going to have a hike. they were blindsided by these numbers today. I mean, that's the scariest part. The people who were supposed to be omnipotent turned out to be impotent. That's really the big story today, that these people have now completely discredited themselves, and you can now just not listen to them all. They're all noise. The only one of them that you need to listen to now is Janet Yellen. I discussed last week, before the Memorial Day holiday, when everybody talked about how Janet Yellen was hawkish and what have you, I actually listened to her. I actually listened to her press conference, and before they asked her, about rate hikes, she was reiterating a lot of the stuff that was in her famous speech that was on, which was the Yellen day, 3/29. She talked about worried about the dollar, she talked about transitory, she talked about fears of global growth. She was the same dovish Yellen that she has been for a while. That speech she gave, that presser that she gave, that turned me from getting more bearish and thinking that the rally was going to be shortable, put me into the new all-time high camp because she had such a huge change. She basically said, I'm sorry, I'll never do it again, it was a mistake, and we're not going to hike. Now let's fast forward to the prior weeks. I said that I thought that the market had overly taken the Fed out of the picture, and that I expected as we got closer to the meeting for the probability of a Fed hike to rise. They rose a hell of a lot more than I had expected, and I think that was just simply a function, and this is going to sound very familiar to those of you who watch me. I always talk about a slingshot, and pulling back the I don't even know what the term is, but the sling, it had gotten so overly cocked that it just slammed so far, so fast, it went further than usual. That's what happened with the Fed probability. It was so badly discounted out, so many people were on the wrong side of that it overcorrected. I didn't read anything more into it other than that, and that was because I followed the data. I listened to Yellen. I actually listened to her speeches. I read the data. I go through these reports. A lot of the people on TV just follow the numbers. They don't look what's behind them, and that is very, very important. So that's why the market got it so wrong, and why we, the collective we, the royal we in some instances, but I will say the collective we, because I know a lot of you have gotten very smart and are watching this stuff now too, we got it right. The interest rates now have, the potential for rate hikes now have been moved back quite substantially, basically to where they were before all these morons got talking. They need to just shut the F up already because they don't know what they're talking about. The interest rate, the probability of a hike now in June is 4%. The July number is 31%. I expect that number to drastically drop. September is now back below 50. That is key. It's 44%. I expect that number to drop. November is 46%, below 50. December, 61%. That will not budge that much. I am fully still expecting the I gotta keep our reputation rate hike in December unless things really fall apart. It'll be post-election. I think the Fed will want to show that they're not complete idiots, and that'll be their Christmas gift to the markets, a rate hike. They really should not be hiking. Let's go over what Yellen has said. These are her own words. We have a lot to unpack here because this is very key. It may sound boring, and I may sometimes sound like a broken record, but if you can get the Fed, you can get the market. You have to understand the game the market is playing. If you know the game, you're more than halfway there because this is what all the algorithms get tied into. So let's talk about what the battle is in the market. Who's fighting who here? In one camp, one side here, and this has been the losing side, have been the people who say that the stock market is overpriced. It is trading at a PE multiple that is higher than normal, and it isn't warranted given the slowdown in revenue and in earnings growth. That makes a ton of sense to me. It's very smart. The problem is that it's not the game the market is playing now. The game the market is playing now is that interest rates are historically low. You had the 10-year way below 2%. I think it made a new low. I don't think it made a new low, but rates are super low. I think it was like below 1.7% today. that interest rate, that low number, creates a premium, so to speak, in the market. Think about where the markets have topped out before crashes. It's usually around 6%. Between 5 and 6, it's usually 6. It's what crashed in 2000, 2007, and oddly enough in 1929. The market is trading at roughly about 19 times earnings. That is a lot. When the market gets below 10 times earnings, it's unsustainable. When it gets above 20 times earnings, it becomes unsustainable on the upside. And we're right up against it. The problem there with that normal, rational, historically accurate line of thinking is that interest rates aren't 6%. They're not 5%. They are below 2%. That means that PE multiple deserves a premium, even for these crappy earnings. The reason is if you go into a bank and you try to take out a CD or you put your money in anything, you cannot get a real return on it. That forces people into the stock market. It forces them into utilities. It forces them into REITs. It forces them into MLPs. It forces you into riskier and riskier assets. Yes, it's a game of musical chairs, and round she goes. Where she stops, nobody knows. But the problem is with that is that the music can play quite long, and it can go longer than you can stay solvent if you're trying to short. That is the game that the market is playing. It is that PE multiple premium. It's get the market higher. The market, believe it or not, and we'll see, I think we'll get a better handle of things next week, but it has acted actually quite strong. It has rallied. It has held. The pullbacks have been minor. The breadth on the pullbacks have been almost like up days. Here, hold on, let's see. A lot of liquidation moves this week in the market. Yeah, the liquidation breaks. Someone was asking about liquidation breaks, what they are. So when I talk about them, I often talk about poor highs and poor lows and liquidation breaks or short squeezes. That's really what's been characteristic of these ranges. Liquidation breaks tend to happen when you get markets with late to the party bulls who are buying near the highs, and then if they don't get immediately higher, they're disappointed and they sell, and you get what's known as a liquidation break. It was very evident to me, by the way, this morning that this morning weakness was a liquidation break. How can you tell the difference between a liquidation break and real selling, so to speak? The answer is that they're both real selling, but the difference is who is selling. That is key. If you looked at the market this morning, you have to look at the internals, the breadth, for example. Trend days to the downside, meaning large institutional selling, bigger people than you, people who don't want to just sell 100 or 1,000 or even 10,000 shares, people who want to sell tens of thousands or hundreds of thousands or even millions of shares. You will see breadth 5 to 1, 7 to 1, 8 to 1, 13 to 1 negative. The breadth this morning, the NYSE, the New York Stock Exchange, opened up positive, and the NASDAQ was down 2 to 1. At the worst, I think that the NYSE was down like 2 to 1, and the NASDAQ was down 3 to 1. That is not trend day internals. That is not institutional selling. That is all people who bought at the close yesterday, near the highs, who thought that we had to have a gap up today, and they were disappointed, and they stopped out. That is what happened. So the liquidation breaks take out potential sellers, they suck in shorts, and that's why we get this, higher market. The breadth, oddly enough, on up moves have been stronger than the breadth on down moves. That means bullish. I talked about all right, so here was my recent really big call. Every technician I follow, all of these geniuses talked about a head and shoulders top forming in the S&P 500. The problem they encountered was that they didn't look at the internals of those bars. They just looked at the pattern. They didn't put it in context. The down days, some of them had positive breadth, and at the worst, the breadth was like this flattish type of breadth. It was like trying to sell and not getting much for it. I said I thought we were going to get up to the 210 to 11 area where we did, and I thought we would see a pullback. The problem was going to be, was the pullback, I'll get to that in a minute about the breadth. Someone asked about the breadth. The problem was that we got into some reference resistance, and The question was going to be, did we have a sharp pullback, or was it going to be kind of like a grinding slow pullback? And that is what we got, the grinding slow pullback. We held a lot of key levels. I talk about my levels, and the example I always give is sort of like you never leave your wingman, like Top Gun, right? The advice Jester gives to Maverick. You did really well, kid, up until the point you died, and never leave your wingman. I probably didn't quote that properly. Jeremy Ironside will have to forgive me. But the truth is 204.12. That is a key level. Anytime we have had particularly Friday closes below there, we have had Monday crashes. We knew the Fed was supposedly hawkish and all this stuff, and on 5/19, we had what was known as a look below and fail. That means price probed below that low and couldn't hold. It didn't find acceptance, so to speak. It didn't encourage more sellers. It found buyers. We wound up closing above the 204.12, and then we had a gap and hold the next 2 days, and then we went to the upside. The head and shoulders pattern invalidated above 208.5 to 208.54 in the SPY, and now we are trading above that range. I've talked about the upper distributions. If you're really curious about this, you can watch this in my weekend review video. I'm going to show this in painstaking detail to the tick in instances, because these levels are hyper accurate, and you really need to have hyper accurate levels in this type of tape. 208.97. It will be very hard for me. 208.97 is our new 204.12, by the way, for now. And I said we could have some slippage to 207.97. We'll talk about that in the weekend review. I don't want to boggle you here with it. But my point is that as long as we're above 208.97, you have to be thinking higher. I'm still thinking all-time highs. If we get below that range, I'll maybe be a little less bullish. I'll think more neutral. And then I'll talk about where I would get bearish again in the weekend review video. But it seems to me, if you look at the weekly chart, we had a big up candle and now basically a kind of doji within that candle, and that to me looks a little bullish. You can use this week's low as a stop if you're long. We'll get into that in the weekend review video. Anyway, the point being is that the market is basically right now handling a lot of disappointed bears and a lot of people who maybe think they're smarter than they are, or maybe they are smart, but they're just not at the right game. They sort of wore protective padding for football, and we showed into baseball season. It's sort of just how it is. Anyway, let's get into some of the levels here that are super key. Let's just use the range low of this week. As long as, like I said, as long as we're above this 208.86, 208.97, that it was today's low, I'll just say, the game is to the upside. If we start getting below there, you can be a little bit more skeptical. Let's get into what you guys want to talk about. So one of the key drivers in the market, and one of my big concerns, let's just do the 6 market keys and the Fed key. We talked about the Fed already. I don't want to go too much more into that. Let's talk about the keys to the market here. What was the big tell today? How did I also not think today was a trend day? Because someone asked me about that. The breadth was a big tell, and the VIX was a big tell. The market took out yesterday's low briefly. We wound up putting in a secure low. I'll show you all of this in the weekend review video. This is all really how to trade, internal characteristics. But the VIX did not make a higher high over yesterday's high. That should have been an immediate alarm. By the way, the VIX today wound up closing toward the lower end of the range, so we have to be a little bit cautious there, but really did not put on a very impressive performance. And it actually it briefly made a new swing low, although it didn't close on the dead lows. So that was a big tell. The dollar, that was a biggie today. So we talked about, I had said I thought we were going to see a rally in the dollar. It wound up stopping roughly around where I thought it was going to stop. And we had a gap and go below the range in the UUP. Again, I will show this in the weekend review video, but a lower dollar is great for earnings. It's great for U.S. companies. We had treasuries rallying. We had dollar down. We had VIX not able to take the highs. These are all big, big tells. If you stick to the keys, the market keys that I have laid out, you will definitely understand a lot more and likely improve your trading performance. HYG, that was another biggie. This is what Yellen talks about. That wasn't dumping either. Let me tell you, anytime you have a credit crisis, that is what leads to a crash. People have to not be able to access capital to fund margin or business or whatever. You can't have a really big decline in the economy or the markets until you have a credit crisis. We don't have that now. We definitely don't have that. We have actually a lot of liquidity, and you have a very accommodative Fed. That, I think, is what's confounded a lot of the bears. You need to start seeing, and I don't want to put people to sleep. I know it's late on a Friday. It's probably drink time, but you have to see LIBOR start rising. You have to start seeing signs of credit stress in the system. You have oil that rallied a lot. It doubled. That's taken a lot of the pressure off this sort of junk paper. It's allowed companies to hedge and refinance their structure with options. That's a biggie. One of the things that is concerning me slightly here is that we're starting to see some oil rigs come back online. I think OPEC is, I'm not ready to quite write off the cartel, but if they start putting more and more rigs on, I get a little nervous. We are coming into hurricane season, which I guess is good for oil prices, but you definitely don't want to see too much capacity come back online because that will obviously hurt things. I talked about 49 to 52 being the upper end of this range, and I talked about booking profits in the 49s. That turned out to be basically correct. The back off here, though, has been rather mild. I am just looking. We're basically right on the 10-day. We're still above the 20. We're still in the channel, and we're just kind of consolidating here. You really have to see oil crack to start seeing some big issues. I often say take a look at XLE and Exxon. Those are the great tells, and the pullbacks in these have been almost non-existent. Exxon is pulling back a little bit more. I talked about a RoRo trade coming up. I hope we even get there, but the 50-day is coming up. I'll show that in the weekend review video. I'm trying to be a little bit of a tease, I guess. That, to me, would be a good opportunity to play for a right or right-out play. So that's that. XLE also, I think the game there, again, is to the upside. You may have some pullbacks. You're starting to have a little bit of a lower high here, but again, above the 50, the 200-day was really the key, the breakout above there. I would be all over this on a retest of the 200-day in size for right or right-out trade. Let's just leave it at that for now. Someone was asking about, you guys are asking about some stocks I don't necessarily always follow. All right, so I'm just looking at this Target chart. Someone asked about Target. You're basically held, you had a look below and fail the 61.8. Let me zoom in a little bit. Retail, we know, has been terrible. This is all, again, thanks to Amazon and AI and automation and so on and so forth. Amazon, by the way, is the vanguard of that, and I expect that to continue. I think I talked about it in the weekend video. I had bought something in Best Buy, and then I realized why Amazon was at $700. You don't have to deal with the incompetent people in these stores. You know, all they want is more benefits and higher wages, and that is just fueling AI and automation. It's going to be in fast food. It's going to be everywhere. I'll tell you this, and you can say you heard it here first. AI and automation is going to start eating into white-collar jobs soon, too, and that is going to be a disaster. It's really starting off simple with the more blue-collar jobs, but it is going to bleed into the white-collar. I don't want to unveil my details on that, too, but it is coming. So, Target. You have a gap high that day of 68, 62. If you're above there, I guess you can play long. If you're below there and the pullback low of 66, 79, you want to probably be playing a little bit more short. This looks a little double toppy, lower high to me. I'm in no rush to buy that. Retail tends to do well later in the year. I'm not a big fan. If you like Target and the like, my favorite retailer, and I do have one, is TJ Maxx. I don't have a great history with this stock. I've always wanted to buy it. It just never pulls back enough, and then the pullback never seems big enough, and I'm always sort of waiting. I forget what that quote is, Johnny Depp in Blow. I feel like the last day of summer and I was left outside or some kind of crazy thing. I would wait for TJ Maxx. That is actually benefiting from the woes of the Targets, the Ross stores, the Nordstroms, because they buy the overstock. They sort of when all these retail big box stores like Bloomingdale's and stuff get all the new inventory and they can't sell it, they blow it out to TJ Maxx, and then TJ Maxx, the worse retail is, the better it is, believe it or not, for TJ Maxx, because they're getting all the closeouts and the markdowns and stuff, and then they can sell it to their customers, who tend to be probably a little less affluent, and they basically are probably less likely to be the ones shopping online. Allergan. So someone asked me about this just now. Looks to me like a Head and Shoulders top. We know they had the failed deal with Pfizer. The rally now is starting to, I guess, look a little bit overbought. It might fill the gap. Believe it or not, the gap fill would take you to the neckline. I'd be encouraged to probably short if we can get up there for a right or right out trade, somewhere near the gap fill in the 200 MA. Usually you have the Head and Shoulders breakdown, the check back to the neckline, and then the resumption of downtrend. So you might have a little bit more up move in Allergan, but the pattern is not a really good looking pattern overall. I like the company, I like their products, I just don't like the chart all that much. Someone asked about Facebook. Holy cow, there looks like there was some kind of crazy spike in Facebook. This has to be a wrong tick. I don't remember this ever seeing 135.60. I would assume that is a false tick. You are trapped in the twilight zone of the earnings gap range. These tend to go sideways, then fill the gap, and then resume up. I like Facebook longer term. They are kicking ass and taking names. I love what they're doing with Instagram. I think the Snapchat IPO, when that comes out, which is going to probably do really well, that, by the way, is doing fantastically. I think I had underestimated Snapchat a little bit, but I am now more on board with that situation. I think that's going to show just how cheap Instagram really is, and that should be a PE multiple booster for Facebook. Someone once asked me a year or two ago, I think I was on vacation in Puerto Rico at the time, actually. Someone asked me, do you ever think that Facebook will eclipse Google in terms of earnings or revenue? And I went back in and I looked at the earnings. These are the kind of things I do at the pool, right? Daiquiri in one hand, or probably a pina colada more likely, and looking at earnings for Facebook and Google in the other. So I looked, and the revenue growth and earnings growth for Facebook is faster than Google, and that will explain to you why Facebook has been getting a PE multiple premium over Google. Also, look at the trend. The trend was from print to online, and now from online to mobile and social. Facebook is the only one who's been the masters of social, or at least I should say monetizing of social and mobile. I think that they are going to continue to do well. I think the stock is going to eventually go much higher, but it is in a bit of a consolidation pullback phase. I would wait for some type of a larger market pullback. I do think that the stock is going to see one in the 130s, probably sooner than later, but I don't know that it isn't going to pull back. The 200 MA has been rock solid support. That's 104.60 currently, as has the 50 before. That's slowly creeping up to the 116s. So I think that the options in Facebook are rather cheap at the moment. The implied volatility and the IV let's just talk about IV percentile. That just means where volatility is in relation to historic volatility. It's at the 6% IV percentile. If you're long shares, just buy some longer dated puts and chill. And if the stock goes down, then you could sell out of the money puts or whatever. Trade around the position. Or if you're a bullish, you can buy longer dated calls or call then make it spreads eventually or whatever. That's the way to play. You got to play purely directionally in Facebook. I personally, it's a longer term play for me. Short term, I'm a little cautious. Longer term, maybe more bullish. Qs. All right, so the Qs have a lot to do with Apple. I like that they held the 104, 105 level. That is very key. It's currently holding over the 109.38. That's kind of key. You have a 10-day moving average there. I'll go into more detail on this in the weekend review video. If you were the one who asked about Qs, wait for that. I'll wait for it. I'll talk about it. Lululemon. Someone asked me, this is one I had liked a while back. I haven't been really trafficking in this name for heavily, at least not publicly, for a while. Let's talk about Lulu. It broke the downtrend here. It's had several attempts at doing it. It seems to be holding well, the 200 on the weekly. That's good. I listened to the owner. It sounds to me like he's either doing one of two things. One, he's trying to get the stock higher so he can sell out. He's kind of done with it. He's had a lot of problems with the board. So I think he's either he's kind of put a put in the stock where people feel if it gets low enough, he'll arrange a private equity buyout for Lululemon. I think he would have no problem doing that, by the way, if the stock got low enough. It's a great brand. It's well known. He's the founder. I could easily see that happening. Or the number two thing, he is actually going to arrange it. I'm a little less inclined for that up here, but you never know. But it seems like that stock is likely a kind of BTD stock, but I'd rather not do the chasing. I'd rather do the dip buying with the Lulu. Lending club. Someone asked about that. One I don't talk about often. We all know the deal that they do the peer-to-peer lending. It's under a lot of scrutiny and some investigation. This is a binary play. It's either going to fill the gap and go much higher, probably double or triple, or it's going to zero. It's just that simple. Longer dated calls, I guess, if you want to play for the long side. I probably wouldn't play for a zero here. It seems unlikely to me, but that's just one you're going to kind of have to, it's a lotto ticket. You're either going to be really right or you're going to lose it all. It's simple. It's a binary event. What is this nonsense? Someone asked me, what is this, a levered ETF? Let's see. Why isn't the symbol coming up? Hold on, give me one moment. Yeah, for some reason the levered ETF isn't coming up. This has to deal with the VIX. I don't like playing the VIX directionally. What I like to do with the VIX is use it to determine if I want to be long or short SPY. Let's see, UVXY. Yeah, I know UVXY. Here's the deal with these. They all have negative drag because they basically roll futures contracts or they're not that great. You can play these intraday, but for longer term plays, I'm just not a big fan of them. I know some people like to just be short these things all the time. The problem is when you get the spikes, they can be quite high and cause problems. I tend to just not play around with these things. If I'm going to play, I like to see where the VIX is in the range, and then I'll take a short on some, cheaper SPY options, like buying puts or whatever. And then if, premium gets real high, then maybe I'll be more inclined of selling those, those puts. I'll tell you this, I've never really made a lot of money playing the VIX directionally. It's usually baked into the options, and it's just not what I do. There's easier fish to fry, so to speak. JP Morgan. All right, so the deal with the financials is this. Someone just asked about it. Interesting. All right, so here's my spiel. When these stocks get below 9 times or below 10 times earnings, you've kind of got to just buy a little bit of them. I use Morgan Stanley as my proxy. Some people may say why. I say why not? It had a inverse head and shoulders neckline breakout in the 26s. As long as Morgan Stanley is above 26s, you could kind of be long some of these financials. If it gets below there, it gets a little iffy. I liked that the late day MOC started filling out and you got some buys in some of these financial stocks. The problem for me with the financials are twofold. You could do the American 2 or the German 2. So here's the deal. They were regulated. They don't have the same earnings profiles as they did pre-crisis, Dodd-Frank and all that. Oddly, the problem of loose mortgage lending standards was not fixed by Dodd-Frank. You could have the financial crisis all over again, and none of the regulations that were taken did anything to stop it. All they've done is hurt banks' profitability and their books that actually used to make them money. Banks need a couple of things to go in their favor, and first and foremost is interest rates. If interest rates don't, they're basically savings and loans these days, and the chargers of fees. Yeah, I mean, they'll be all right to pay the dividends. Their balance sheets have been firmed up. I don't really see, I mean, yes, there could be some European exposure and what have you. I'm a little less worried about that with what went on in EEM today. I'll talk about that in a minute. But I think that these stocks, if you really are playing for rate hikes and you want a big profit center, I like the insurance companies better. Travelers, I think, is the best in show. It has the best chart. MetLife is pretty good. I mean, that seems to be in a little bit of a funk lately, but Travelers, best in show. Wait for some pullbacks in those. JP Morgan is pretty good. I noted in my in Twitter today that the 50% fib volume distribution and the gap fill is roughly around the 59s. If you could get the low to mid 50s, you probably could sell some puts. Has a decent dividend yield. It's, of course, the best managed one. Jamie Dimon is a total stud. Yeah, Prudential, that's another one. Let's take a look. I don't really follow Pru all that often. Yeah, it's just been rallying. It's doing the motorboat, holding the 50 MA. The best chart of those, I will say this, is the this one's in a little bit of a funk also, a bit of a downtrend. But I think the best of the best of show here is Travelers. That's TRV. It sort of, I think, has the best of the chart patterns, but they're all basically the same. The deal, though, here is that rates aren't probably going higher for a while, so if anything, they're going lower, so there's really no rush in these. Like I said, but if you want to buy the banks, just wait till they're below 10 times earnings and then nibble away. Alrighty. EEM, someone asked about that. So this is forming a bit of an inverse head and shoulders. It looks to me like hold on, I want to pull up a longer chart. 5 years weekly. All right, so the old reference low in 2011 was 33.42. You had a bit of a breakdown there, roughly a little bit ahead of trend, and now it's kind of going back higher. If you want to play that and you're worried about credit and all that, you really would want to see this breaking down below like 31.70. That's on a weekly, it looks like a secure low on a weekly chart. The secure low, by the way, is usually a bar with a little bit of excess, a tail, bookended, meaning on either end with two higher lows that are usually roughly about equal. Last week looks like it put in that secure low, and now you're above that bar's high. So as long as you're above this week's, or I should say last week's high, which was 33.28, and let's say 32.91, that range, probably the path of least resistance is higher. That means that credit and the world is sort of thawing a little bit. Today was a gap and go above the 50 MA. That's always a good sign, bit of a gap to fill. I'm not this is a little bit new to my thesis here, so I want to develop it a little bit more, but those are the key levels with that. I think we've covered quite a bit today. I will cover more in the weekend review video, but just keep an eye on those SPY levels. That's really what's going to matter. No, I don't trade or own Bitcoin. Someone asked me about that. Don't really have that much view on it either. I just basically trade in the stock market. If there's a Bitcoin ETF or something that you know about that I don't, just let me know. I'll analyze it. Anyhow, that's my story. I'm sticking to it. If you came into this broadcast late or want to watch it again, it will be on my YouTube channel very shortly. As soon as I finish the broadcast, I'm going to begin the upload process. These videos tend to be a little lower resolution than the ones I post in the weekend review, so they will be up quickly. Anyhow, that's my story. I'm sticking to it. I will catch you on Sunday. Cheers.